Well, holy smokes, the Dow Jones Industrial Average is down over 17.9% in March alone. The S&P average down over 13% in March alone. Both of them down over 23% since their peaks. We definitely have some big discounts out there to go shopping for. Yet, I'm kind of curious. Are we going to see another big dip in April? Are stocks gonna double dip right back into the pooper, or are stocks gonna float back upwards nice and slowly? And how is that going to affect real estate? Well, today, I'm gonna share with you nothing other than complete speculation on my opinion. So if you choose to keep watching, you're just getting my take, and I'll show you exactly what my plans are for my cash, how I'm investing, and my expectations. So let's get into it. Kind of flattering that you would choose to stick around for some speculation from a dude that wears a shirt with a berserker helmet on it that he custom printed just so he could show off his berserker helmet. All right, folks, obviously there's a lot of bad news out there. The CDC expects over 100,000 people passing away in the United States. Donald Trump mentioned that we are expecting to go into the worst 2-week period going forward now, which means from April 1st, essentially to April 15th, we're looking at more and more bad news every single day. Essentially, it appears that they believe these 100,000 people passing away could literally happen over the span of the next 2 weeks, which means over the next 2 weeks, we're gonna see nothing but doom and gloom on the news. But has the stock market already priced this in? And how is this gonna affect real estate? Does this mean there are gonna be more properties for sale or less properties for sale? Well, this is where it helps to look at history, in my opinion. Obviously, real estate history and stock history can't predict the future, but at least it gives us something to look at. Something that I found was very interesting was that real estate prices were going up between 2000, 2001, kind of leading up to 2005. We saw this nice spike in real estate prices right before the 2008 recession over here. But the interesting thing that happened with real estate is because real estate's so slow moving, essentially, we started seeing real estate prices kind of taper and start trending downwards. This beginning trend started very, very early in real estate. And what's fascinating about it is it actually took quite a while for real estate prices to hit their bottom. Real estate prices did not hit their bottom until about November of 2011, which is a dramatically long real estate cycle. Look at this, from about November of 05 to November of 11, that's about a 6-year real estate cycle thanks to the Great Recession. Now, the Great Recession was obviously, essentially, a real estate panic. Foreclosures, repos, short sales, dead people getting loans. It was a full-on credit and real estate disaster. But let's now go ahead and overlay stocks. So let's say that stocks were pretty similar there at the end of 2005 to real estate. And the interesting thing that happened with stocks is stock prices sort of kept continuing to go up all the way through about the mid to end of 2007, beginning of 2008. 2008's right about here. So we did see, some kind of volatility. We saw a little bit of our bull trap, and then we saw this plummet in stock pricing. But fascinatingly, by the end of 2011, a lot of the indices had recovered a dramatic amount of their values already in stocks. So when we look at this very neat and clear representation of what the market did, we can see that, wow, stocks can fall fast, but they can also recover really fast. Where in a real estate induced panic, you get a very slow down and a very slow up, which is kind of that up that we have been seeing in real estate. But real estate isn't always slow. See, real estate prices may have bottomed at the end of 2011, but they started coming back throughout 2012, and at the beginning of 2013, a lot of real estate prices jumped up almost 15% nearly immediately. The same thing happened, almost in reverse, in the spring of 2018, where in the spring of 2018, our market was booming and all of a sudden the real estate market got tanked a solid 12% and it took almost the entire next year and a half to recover the values that we lost in the summer of 2018. This is because real estate interest rates skyrocketed from rates around 4% all the way up to about 5.25%. This was along the same time as the TTP, the Trump tax plan. Now, this happened in the spring and summer of 2018. We had a solid maybe 4 to 5 months of rough time with real estate in 2018's summer. A lot of flippers were losing money. This was a bad time. Yet, all of a sudden, real estate starts improving, and then at the end of 2018, guess what happens? Boom! The stock market gets spanked. Except the stock market recovers in about 45 days when the real estate market took about a solid 180 days to fall and subsequently recover again, possibly even more for the recovery. So the point of looking back at these last sort of 3 hits is we can see real estate is typically slower. Real estate can suddenly fall if the interest rates are manipulated, but usually real estate is slower to fall and slower to rise again, where stocks can move very, very quickly. This to me is very interesting because it makes me think of institutional investors, hedge funds, or companies running mutual funds. What do they generally want? They want more people depositing money with their hedge fund. I mean, think about this practically. If you and I said, hey, you know what? Let's start the Meet Kevin and, you Capital Group. So we're calling it MKY, okay? We're the MKY hedge fund. The only thing we really care about, let's be real here, is fees. We want money. And we make more money in fees at our hedge fund the more people give us money. Well, generally, hedge funds and mutual funds and basically any kind of investment company attracts way more money if they can show that, well, look at how great we did over the last few years. Look at how great we did in this crash or that crash. Don't mind that one over there, but look at how great we did over here. The point is, large companies, institutional investors, hedge funds, mutual funds, everybody's trying to attract capital. And we're no different at MKY, right? We're trying to attract capital, which it's okay because we're gonna believe that we're gonna be able to do the best for our clients. And the better of a job we do for our clients, the more people are gonna deposit more money with us, the more money we make, and it's win-win. It's totally okay. There's nothing wrong with this setup. Except here's where the problem comes in, and this is why the stock market can suck, and especially funds can suck, and this is why I like investing my money myself. Funds can suck because what happens is when people start getting really sad in the marketplace and they start seeing pricing go down, and then all of a sudden, we start thinking to ourselves, oh crap, I'm holding a bag of doo-doo worth of stocks and they're getting stinkier by the day, and now my hedge fund manager is telling me, oh, well, come on, be fearful when other people are greedy and be greedy when other people are fearful. We should be buying stocks. I already got a bag, okay? I don't need another bag. No, and I don't want to catch your fallen knife, because I want my money protected. So what are you gonna do, hedge fund manager? You either protect my money or I'm taking my money out. And that's literally what happens. People get fearful, and this is okay. Like, I get fearful too. Like when the stock market falls like 10% and 10% and 10% and the circuit breakers are tripping, it's like, oh gosh, I know I'm supposed to be buying stocks, but like, when is this gonna end? Like, if somebody could just like bat beacon me and tell me where the bottom of the market is, like that'd be wonderful, then I would buy. But unfortunately, that doesn't happen, and instead, we're panicking, we're freaking out, and so where do we vent? We vent to the hedge fund managers, which means we're picking up the phone, listening to people freak out, going, we're taking our money out now, ASAP, sell, I don't care. Unless you start protecting my money, sell. So basically, we now have 2 people calling our office. People who A, definitely want their money out, or B, people are like, I'm gonna take my money out if you don't do something. Like, do something already. And that leads to more institutional trading, more institutional losses, and more institutional trades that take money from assets that they should be buying and holding, and then they move them over into, oh, well, this is gonna be safe, we'll put it into this bond, or we'll put it into this ratio of fund, or this gold index, and this crap, or whatever, and then we'll move it all back when the market's at bottom. I mean, it's great in theory, but even amazing people that I admire, like Ray Dalio, who spent over $1.5 billion on put options, still managed to lose 20% of his portfolio's value during this last crisis. That sucks. You can bet he was getting a lot of sad people calling up. So in my opinion, this kind of crap is exactly why we see massive volatility in dark times. This is why we see so many green days followed by massive red days and big green days followed by massive red days. And it makes us just think, oh my gosh, where's the bottom? We're trending down. This is horrible. This is bad. Oh my gosh, the world's gonna end. And then all of a sudden, after we panic for a few weeks or sometimes a few months, we start going, I could get used to this for a while. I am working from home, been working in my PJs all day long. Yeah, there are bad things happening and not trying to talk that down at all, but we start getting a little bit more callous and we get used to the bad. Now I'm gonna draw some conclusions, at least that I'm making with stocks, but I wanna spend a little bit of time now talking about real estate, which while I talk about real estate, make sure to load up on some more educational material so you could learn how to make money in real estate when and if prices do start trickling down. You gotta know how to be an expert, so join me in those real estate investing and do-it-yourself property management courses linked below. There's also a course on personal finance, money, and sales. How does real estate react in a situation like this? So real estate's actually interesting because in the last examples that I gave you in 2008 and that 2013 kind of jump and that 2018 fall, real estate was first. Real estate was the indicator for stock market crap to come. And that's usually because as real estate values fall, people's household wealth erodes and they feel less comfortable buying stocks, so they load up on cash by selling equities, aka stocks. This totally makes sense. It also doesn't help if big investment firms like Lehman Brothers or AIG basically go bankrupt and the government's going, you live, you die, you live, you live, but over here, you Lehman, nah, you stay dead. But interestingly, in this case, stocks fell first out of instantaneous fear that took over our country. And this uncertainty leads to radical moves in the marketplace. But real estate is much more slow moving. Real estate only reacts quickly to interest rate declines. Otherwise, real estate takes a while to react. Now, last week I brought you a video on the real estate market and I shared my thoughts and ideas about what was going to happen in the marketplace, but mostly I wanted to show you the data of what was happening in the real estate space going into this crisis and things that we should look for. Going into this crisis, things were incredibly green and powerful for real estate. Unfortunately, a lot of those statistics are representative of sales from December, from January, from February, where this crisis wasn't really in full swing yet. And so what we really want to do is watch what happens to the data in April. But interestingly, because with the exception of interest rate shocks, real estate moves so slowly, real estate might not show significant damage until all of April passes. Heck, until May passes. Because right now, sales data and velocity and momentum is still so strong. We're also seeing essentially an equal amount of less sellers as we are less buyers, which interestingly means that when properties are hitting the market that are still priced appropriately, they're still seeing multiple offers. People are taking advantage of great deals. So that all sounds good, but at the same time as all that sounds good and the initial data's good and things are still okay, we see FHA loan requirements going through the roof. Banks are starting to tighten lending standards. We see people getting denied for home equity lines of credit that were initially approved. We're seeing jumbo loans cancel. And because of stock market declines, we're seeing people's down payments obliterated to where they can't even afford to buy property anymore. This isn't even to mention the amount of tenants not paying rent right now, which is obviously a substantial burden on commercial real estate and a lot of rental real estate. And there's also a crisis brewing in mortgage loan servicing. I mean, there is a crisis brewing everywhere. So this has to have some kind of impact on pricing, right? And the easiest way to explain what my expectations are is just to show you exactly what I'm doing with my money. So here's my plan for my money. Right now, I've drawn all of my credit lines and I'm parking money from some refinances that I'm closing all in one place. And while I'm keeping a larger kind of war chest available for wedge deals, that is below market value real estate, I'm doing something else as well. Now, quick reminder, what happens when I buy Tesla stock for $500? Well, the price either goes up tomorrow or it goes down tomorrow. But the market value today, right when I buy it, is $500. What happens tomorrow is speculation. What happens in 20 years is investing. That's stocks, which don't get me wrong, I love stocks. But an interesting difference when it comes to real estate is that today I can purchase a property for $500,000 that I know I could resell today for $600,000. And that's because of information asymmetry in real estate. Stocks, when I type in TSLA and I press buy, I do that from my phone. It doesn't take a lot to do it, to actually execute. But when it comes to real estate, that means going to a property. Oh my gosh, what's plumbing? What's roofing? What's electrical? What flooring do I use? How do I do this? How do I do that? How do I do this? There's a reason I have a separate rental renovations program from the real estate investing course, because there's a massive amount of information to learn. But the nice thing is that massive amount of information can pocket you some really good money, because all your competition doesn't know this stuff. People who don't watch me on YouTube, and especially people who don't take the courses, because I can't put everything in the courses on YouTube, and I haven't even put a fraction of the content from my courses on YouTube. But the people who watch this, you're able to take advantage of this information asymmetry, which actually lets you buy things below market value. Again, you can't do that in stocks. So in terms of my cash, I'm building a war chest of cash, and I already have a war chest of cash. Some money coming from refinance, some from credit lines. So if I want to, I could pay these debts off again. I don't like to be too debt heavy. I'm pretty conservative. But the other thing that I'm doing is I'm parking this cash ready for one of two things. Number one, always my favorite, always my preference is real estate. Yes, I mean, this should be obvious by now, right? But I want to talk more about the number two. Just quick reminder, yes, real estate is the number one. I would rather, even though I never sell stocks, I would rather sell stocks at a loss if it meant I could guarantee a gain in real estate, because usually the gains I can get in real estate are big and instantaneous because I can qualify it like this. But what about stocks, and how do I piece all of this together? Well, because stocks led the crash, and because stocks move faster than real estate, I personally expect that even though right now, we've seen this kind of exponential growth in stocks, we've seen this dramatic kind of crash in stocks, my expectation is it would be completely expected and reasonable for us to see either a U-shaped recovery or a V-shaped style recovery. One of these doesn't really matter. I think we'll get there one way or the other. But at the same time, as we see this recovery in stocks, we're going to see this slower sort of trickle down in real estate based on fixers that hit the market. I don't foresee real estate falling this dramatically. I see real estate slowly getting beat up by a lack of high quality inventory, by an increase in fixer-uppers. I don't expect a foreclosure crisis. And because of that, I expect if there are going to be falls, my thing, and this is sort of just what I've written down, my expectation, complete speculation here, but my expectation is if this crisis continues, but ends in July, so let's go right, ends in July, then my expectation is we might see real estate get impacted somewhere in the neighborhood of 4 to 8% in values. Know that that's really like 9 to 14%, but because interest rates fell so much, they're kind of softening the blow here a lot. So as long as interest rates stay low, 4 to 8%, if this all blows over by July, okay, no problem. And then I wouldn't be surprised to see real estate kind of slowly pick up again. But if real estate now, this is an interesting one, if real estate or this whole disaster ends in December, well then things might be a little bit more poopy. If things last till December, it's quite possible that real estate might experience somewhere around that 10 to 12% hit. If things go beyond December, well, I mean, honestly, then we're just fully speculating, but that's where things are going to become substantially more painful if this lasts beyond December. I don't think anybody expects this really to last beyond December. I honestly don't even think anybody expects this to last to December. So to me, that's not a big concern of mine. I don't see real estate values plummeting 30% unless we way blow past December, especially with rates where they are. I mean, we would have to substantially have some massive bad news. The same is actually true about the stock market. If the stock market is expected to see another decline, I think it would only come after some substantially further bad news. I'm not saying we're 100% hit the bottom or, March 23rd was 100% the bottom. Maybe it was. It could possibly be. I talked about that, I believe, on March 25th. That was at the bottom. I don't know. We could totally see another decline. But even if we see another decline, I think that's almost just going to be another buying opportunity for us. I really think that as long as this ends within the next 6 months, this is the trajectory that we're going to see. So here's what I'm doing, because there's an interesting overlap built into this. No matter what happens, notice what I believe here. I believe that if real estate slowly trickles down, stocks are going to recover somewhere around the time that potentially real estate values hit sort of a temporary bottom. Which, what makes that very interesting to me is I have this, and again, totally speculative, but this is where I'm putting my money, because I process all the data I can, and I just try to make the most informed decision possible. It is possible that real estate pricing will be 4 to 8% lower at the same time as stocks, especially bounce back stocks, have substantially recovered. Meaning that if you were heavy in stocks and you were buying the falling knives, so to speak, you might be able to kind of blow up your down payment fund, so to speak, liquidate some stocks, and go shopping for real estate when real estate is a little bit on the cheaper side. Now, that does not mean that I am not buying now. If there are good deals to be had now, I will still buy them, because I'm still buying 20 to 30% below market value. If I was expecting a 30 to 40% drop in real estate, I probably wouldn't buy right now. But I don't think any of us think there's gonna be a 2008 real estate crash. Maybe you do. If you do think that, hey, take the course, learn how to invest so you could go buy all the deals. Then I was wrong, and you could buy all the deals that I can't buy then. But this is to say that's not how I'm playing my hand. I'm putting most of my money into cash reserves right now, ready to buy. I'm buying on red days my favorite blue chip companies, those Targets, the Amazons, the Nike, the Microsoft, and even Apple, a company with an extremely high amount of cash reserves. But I'm also keeping most of my money available for real estate, because I do expect fixers to come on the market, and I don't think there's going to be a lot of competition fighting against me, which is cool. So I'll buy a good deal if it comes up, and I'm looking every single day for good deals. I'm also reaching out to agents every single day for good deals using the tricks I always talk about. But it does make you wonder, should you dump some money into some really speculative stocks right now, like Boeing or Carnival Cruise Lines or Darden's Restaurants or Simon Property Group? Some of these are so heavily oversold that there is a potential you could put your money into a company like, the Olive Garden chain or Carnival Cruise Line, and you could see a dramatic bump in values. Or they'll just go bankrupt.